Good morning, everybody. Thank you for joining us today in our third webinar in our personal finance series. Today's topic will be on insurance. As a quick reminder, we have two more of these series upcoming. Next week, same time, same place, will be on taxes. That will be led by our lead advisors, Jake Erlinson and Hope Carlson. And then our grand finale will be 2 weeks from now, again, Tuesday at 11 a.m., and that will be on investments, led by our portfolio manager, Jeff Golsher, and lead advisor Arya Krumbide, who you will have the opportunity to meet here shortly. But today, we're actually going to talk about insurance. I want to introduce myself. So I'm Andy Christopher. I'm an associate advisor at Dowling and Yahnke. A little bit about my background. So I joined the firm last year. I actually spent about 10 years in the Navy. I was an F-18 pilot in the Navy for 10 years, undergrad from the U.S. Naval Academy, and then a master's in finance from Georgetown University. So I'll be your main presenter today, but I'm also joined by Arya Krumbide, who is going to be sort of on the background running Q&A, and I'll let her introduce herself now.
Thanks, Andy. Hey guys, my name is Arya Krumbide, and I am a lead advisor with Dowling and Yahnke. As a lead advisor, I work directly with our clients and advise them on investment management and financial planning. A little bit about me, I grew up in Scottsdale, Arizona, and graduated from Claremont McKenna College with a degree in economics and a master's in finance. Started off my career at JP Morgan in the private bank, and I have my CFA and CFP designations. Like Andy mentioned, I'm mostly going to be operating behind the scenes to coordinate the Q&A. So on your personal screen, you're actually going to see that you have the ability to submit questions. So feel free to do that throughout the presentation. We've also earmarked about 15 minutes after the presentation to answer any additional questions that you guys have. So if we don't get to your question, we'll just ask for your name and your email, and then we'll follow up with you afterwards. All right, Andy, back to you.
All right, thank you so much, Arya. And again, I'll reiterate, we definitely want to have questions today, and we've earmarked that time to answer your questions. So we'll look to answer those as they come in. I think it's also important to note that we'll be recording the session, or are recording this session, and that'll be available by this Friday, either on our website, duywealth.com, or on our YouTube channel to review and watch if you'd like to see this again. I think it's also important to introduce our firm a little bit. So this is, we are Dowling and Yahnke. We are a independent wealth management firm. We've been fiduciary since 1991 when we were founded, and we now manage over $4 billion in client assets for over 1,200 clients. One of our core values is actually education, and that's for both our advisors and all of our employees, as well as for our clients. That's why we're here today, to educate you on insurance. So I think it's important that we level set a little bit, and let's just talk about very broadly, what is insurance? So it's the idea of transferring risk of loss. So if you have a risk that would cause you a severe financial loss, well, you can transfer that to another company or an insurance company. And in exchange for transferring that, you actually will pay that company a premium. So let's talk a little bit about what those premiums actually are. So premiums allow the insurance company to collect money to operate, so to run their business, as well as to pay out claims when an insurable event actually does occur. So I like to think about the size of the premium in kind of three buckets. And one of those is the idea of the risk of the event happening. And you can think about it in terms of frequency, predictability, and the magnitude. So think about the difference between maybe a car crash and a house burning down. Both terrible things, of course, but cars are typically a little bit less expensive than a house. So a premium to insure a home is going to probably cost more than the premium to insure a car. As we start thinking about predictability and frequency, we've kind of seen this already. Forest fires in California, a big ticket item. And we've actually seen some insurance companies have had to increase their premiums because of these forest fires. And again, that gets back to the idea of we have less predictability with these events, and they're happening much more frequently. The other idea, the second component of a premium, is the level of coverage. So as you can imagine, if you have a $1 million life insurance policy versus a $500,000 life insurance policy, and we're going to talk a little bit about life insurance later, but that would command a higher premium for the $1 million life insurance policy, because intuitively that makes sense that we're going to have to pay the insurance company a little bit, or the insurance companies have to pay the beneficiaries more for a $1 million policy. And the last component, the third component, would be the risk of the actual individual that the company is insuring. So think about a 16-year-old brand new driver's license. They get a brand new red Corvette. Compare that to maybe a 45-year-old who's been driving for well over 20 years. They've never had an accident, never had a speeding ticket. Well, the insurance company is going to look at those two individuals differently and consider and rate the risk of those two individuals. So that's how I like to think about the insurance premium as we look to see how much those premiums are actually going to cost, or how is the insurance company going to collect enough so that they can pay out those claims. So to kind of wrap it up, let's do a quick little thought experiment. So let's say the entire world knew your house was going to burn down next week. Everyone was going to be okay. All of your prized possessions would be out of the house. Unfortunately, the house was going to burn down, and the house cost about $500,000. Well, you would say to yourself, well, I don't have $500,000, or I certainly don't want to pay the $500,000 to replace that house. So I'm going to go to the insurance company and say, will you please insure my home? Well, the insurance company also knows that your house is going to cost does cost $500,000, and they also know that it's probably going to burn down next week. So what do we think that premium is going to be? Well, probably pretty close to $500,000. And again, that gets the idea of the insurance company is pricing in the risk, frequency, the magnitude, all of these situations occurring, and that's how they're actually coming up with that premium that you would owe. Are any questions?
Yeah, so we actually had a question that came in, and so this kind of ties back to one of the earlier sessions that we had a couple weeks ago, but do credit scores affect insurance premiums?
Yeah, that's a great question, Arya. The answer is it depends, and it depends on where you live. So there are actually 3 states that require that do not allow insurance companies to use credit scores to influence their premiums. Fortunately, if you're a California resident, that's actually one of those states that prohibits insurance companies from doing that. Hawaii and Massachusetts being the other 2. If you maybe live outside of those states, then yes, they will likely use credit scores to determine their premium. And again, it gets back to the idea of the insurance company is trying to understand the risk of the individual so that they can price their premiums appropriately and understand their risk on their end for taking on the risk that you've transferred to them via these premiums. Okay, so we've talked a little bit about just insurance, the transfer of risk. Let's talk about why we need insurance. And I want to really kind of focus on the idea of frequency and severity. And if we can think about all of our risks in our life as we go through our various life stages, which we'll review later, if we can bucket them appropriately as we've done in the bottom right here between frequency and severity, it gives us a better sense of how we want to treat those risks. So at a broad level, we need insurance to cover low frequency but high severity events that could devastate us financially. So let's go through a couple examples to think through how this might actually play out. So let's look first at high frequency, high severity. So that's this box right here. Let's take, for example, the same house that we just talked about that we knew was going to burn down next week, but instead of burning down just once next week, once a month, the house burns down. Again, everyone's okay. You have great contractors. They come in, they rebuild the home every month, and lo and behold, what do you know, next month it burns down again. Well, this would be high frequency, and of course, it would be high severity. So you could maybe get insurance, but again, the insurance company say, well, your house burns down once a month, so your premium is going to be pretty high. It would be cost prohibitive of you to get insurance, very likely. So we can practice 2 things. We can practice risk avoidance and risk mitigation. Risk avoidance would be, well, I'm just going to move into a different house that doesn't burn down once every month. So you'd be avoiding that risk altogether entirely. On the other hand, we could practice risk mitigation. Maybe we want to find out why that house is burning down. And we go and we look in the basement and we see that there's a pilot light right next to a gas leak. We fix the gas leak, house never burns down again. Or we very much drastically reduce the chances of that occurrence happening. So that would be risk mitigation. Now, of course, we know homes don't burn down once a month. We hope they don't. So then it actually becomes a low frequency event, but high severity. And this is the perfect place that we want to have insurance. And it's best for the insurance company. It's low frequency. It makes it easier for them to manage their cash flow. And as the individual, well, it's high severity. It would devastate us financially to have to replace our home. So of course we want to have insurance. But because it's low frequency, those premiums end up becoming a little bit more manageable from a cost side. If we look on the bottom end here, so we look at maybe some low severity events, high frequency, low severity. Perfect example would be, say you live on a golf course on a par 5, you're about 250 yards down the fairway on the right side, If you have golfers like me out there, you're definitely going to have some golf balls flying into your windows once every Saturday or Sunday. So what do you know, once a week or so, a window gets smashed by a golf ball. Well, again, we could look at it in the context of risk avoidance or mitigation. You could avoid that risk, you could move, but you probably like your home and you probably like the idea of living on a golf course. So instead of that, maybe we could practice risk mitigation. We can install golf ball proof windows or screens. Again, you could probably get insurance, but because it happens so frequently, the insurance company say, well, that's probably about the cost of a window that we'll end up insuring you. And the last component would be low frequency, low severity. Let's take the same neighborhood on the golf course, but instead of living right on the fairway, maybe you live 2 blocks over. And in this case, about once every month, every 2 months, somebody really cranks it right and you break a window. Well, in that case, you'd say, well, it's low severity, windows don't cost that much, it's low frequency. I'm going to practice this idea of self-insurance. In other words, it's not going to devastate me financially. And so in that case, I'm going to take on the risk entirely. We're going to talk more concrete in more concrete terms here on our next slide about some situations where we would want to self-insure. Okay, again, so we talked about frequency and severity, and we want to go through our insurance, we call insurance life stages. So we want to think about, as we go through life, what are our risks, and then how do we mitigate them with insurance? The one constant in life is almost always health insurance. It's expensive. It would always be sort of financially devastating to experience some adverse health consequences. So as we're children, really all we have to worry about is health insurance. As we become teenagers, yes, again, we still need health insurance, but now we start driving, so we want to add on that auto insurance. As we're adults, health, auto. Now we add on homeowners insurance. So of course, we've already kind of covered a lot of the idea of how financially devastating losing a home would be. But for some of us out there, maybe don't own a home, but we rent a house, we rent an apartment. Well, we have a lot of really nice things. And we want to be able to make sure that if something happened to the home, of course, we wouldn't be responsible for rebuilding the house, but we want all of our things to be covered. So we can get renter's insurance. We can cover that risk of all of our computers, our nice, our couches, beds, everything would be covered via insurance. As we become parents, we still need all of those previous insurances, but now we also add in life and disability. So the idea here is now that you're a parent, you likely have somebody you're taking care of, a child or a beneficiary. And if you're in your early age of your financial accumulation, or you're accumulating your wealth or your net worth, well, that could be pretty devastating for your family if that income were to suddenly go away. Unfortunately, that would occur if you were to pass away, and you would need that life insurance to supplement that lost income to take care of your family. The idea of disability is sort of similar. Instead of passing away, now we have some sort of disability. Maybe we were in a car accident. Maybe we had a medical illness that prevents us from doing our job that we were doing previously. And in that case, we would need disability insurance. Same concept, right? We need to replace that income that we had previously. As we become retirees, we still see all of these, but now we have Medicare, Social Security income, as well as long-term care. So Medicare and Social Security income, those are sort of automatic. We're already contributing to those via our paychecks once a month or every 2 weeks. Long-term care is the idea that maybe we have what's called these activities of daily living that we're no longer able to do, and we need some help. Maybe we need someone to come to our home to help us, or we need to go to an assisted living facility. That can become very expensive and is very expensive today, and there's no indication that those costs are going to change in the future, and so we can ensure that via long-term care. The last concept I want to cover and just go back to is the idea of self-insurance. So let's look at it as the retiree with life and disability insurance. And again, it goes back to what is the frequency and what is the financial severity. So maybe you're at a point in your life where your children are no longer in the home, they've graduated college, they've gone off, they're starting their own jobs, or you've accumulated a sufficient level of assets and net worth where you no longer need to take on that insurance and pay that insurance premium. Well, again, because the financial severity has been mitigated by your assets, you have the ability to do that. Doesn't mean you should or you could, but it's definitely an option you have at that point. And again, I just think it goes back to level setting between frequency and risk and the severity of the loss. Okay, I'm going to use this opportunity to get a little bit boring on everybody, and we're going to go through the dictionary a little bit on some insurance concepts. So kind of broad insurance concepts that we know would be premiums, deductibles. I think we've covered premiums pretty closely or pretty in depth at this point. Deductible, we're familiar with in terms of our auto insurance, our health insurance, our homeowners insurance, renters insurance. And the idea of the deductible is this is amount that you would pay before insurance starts paying. And another way I like to think about a deductible is skin in the game. So there's this idea that, or moral hazard, that as you insure risk or you mitigate risk on your end, it makes you more likely to want to take on risk. An example would be, say you drive a little recklessly, maybe you're known to bang up your car every once in a while. Well, if you knew you could just call your insurance agent as soon as you did that and say, hey, I did it again, and they say, okay, well, car will be in your driveway when you get home, brand new car. Well, you would probably drive a little bit more recklessly. But if you knew you had to pay that $1,000 or $500 deductible, not to mention your premiums would likely go up every time you had a claim event or an accident, you would probably drive a little bit more responsibly. And that's sort of what the benefit is of the deductible is from an insurance perspective. It's risk sharing. However, as we get into health insurance, we have some concepts become a little bit more specific. So let's talk about HMO versus PPO. And these are the types of insurance we have. So an HMO is a health maintenance organization, and a PPO is a preferred provider organization. So what's the difference? Well, in HMO, there's this, typically you have to go in network. So if you're a Blue Shield participant via your insurance, you would need to go to a Blue Shield provider, specialist or doctor in order to get that insurance company to pay for that. There's also this idea of the gatekeeper with HMOs. And what that means is before you go see a specialist, you almost always have to go to your primary care physician. So what's the big difference here? Well, for PPO, it provides you flexibility. So you can go to a out-of-network provider, so you don't have to go to that Blue Shield insurance. You also don't have to go to your primary care physician prior to going to a specialist. So again, it's a little bit more expensive from a premium perspective, as well as deductibles and max out of pocket, which we'll talk about here. But it provides that flexibility that some people may like. The other idea is a copay or copayment. This is a flat fee that you pay on the spot each time you go to your doctor or you fill a prescription, and it typically does not count towards your deductible. Copays a lot of times are associated with HMOs. On the other hand, we have coinsurance, and this is the portion of your medical costs that that you will pay after you've met your deductible. So let's say, for example, you go to your physician. The total appointment cost is $100 and you have a 20% coinsurance. Well, you would pay $20 out of pocket and your insurance company would pay the remaining $80 for the entire $100. And you keep paying this amount until you meet your maximum out of pocket. Pretty simple concept, as the name implies. Your max out of pocket is the most you can pay for out of pocket before insurance will just end up paying for everything. So let's look a little bit closer at HMO versus PPO and maybe some of the reasons why we would want an HMO or a PPO. So this is on coveredca.com. This is the open marketplace insurance quote. This is for a healthy 30-year-old couple. They make about $85,000 per year. They go to the doctor 4 to 5 times per year, 1 to 2 prescriptions per year. So all in all, pretty healthy individuals, kind of your standard, health needs in a year. So the first thing we want to look at is, well, the provider is the same. It's both Blue Shield, and they're both the Silver plan. So if you look now, so same provider, same level tier of service, look at the premiums. And in this case, you see that your HMO is about $750 versus a little over $1,000 for your PPO. So, and again, we're looking at our deductible is same, our max out of pocket, our max coverage per prescription are all the same numbers. So what are we doing? We're paying for that flexibility when we go see our PPO or when we go see our provider via a PPO. Let's look at some little more examples. So for the HMO, let's say you wanted to go see a specialist. Well, if you were going to go in network, that specialist would cost $80. If you wanted to go out of network, that specialist would be 100% coinsurance, which is a fancy way of saying you'll pay for everything if you want to go outside of the Blue Shield network. Conversely, now we look at that PPO, and in this case, that same specialty visit would be $80 copay for in-network. However, if you wanted to go out of network, that would be a 50% coinsurance after your deductible. So again, you can see that you can go out of network with a PPO. It may cost you a little bit more. It definitely will cost you a little bit more depending upon the cost. And it's also, I want to highlight deductibles and max amount of pockets on PPOs for out-of-network care are typically higher. So it's something to look out for. What's kind of the big takeaway here, though? Well, you don't want to just look at your premium and say, I want the lowest premium possible, and use that to be your determining factor for the insurance you get. There's no right or wrong answer between PPO or HMO. It's really your own personal decision. I would say, unfortunately, every time we renew our insurance, we don't get a letter in the mail that says, hey, Andy, your appendix is going to have to come out this year. You probably need to plus up your insurance. So we don't want to just go for bottom of the barrel, low cost. But maybe if you're a single individual, you're typically very healthy, you have great network care. In other words, a lot of good specialists in the community. Maybe an HMO makes sense. Conversely, PPO, if you need a lot of specialty care or you want that flexibility, that's where a PPO can make sense. Let's talk about auto insurance. So this is a quote from Geico.com. This is for a 2020 Tesla Model 3. The quote that we see on the left, this is the Geico recommended. So that's this quote right here. And then the quote on the right is what would meet the minimum California requirements. So you can see there's a pretty large discrepancy between the premiums that we would ultimately end up paying for this insurance. So let's break it down a little bit more about what we're actually getting here. So the first thing is bodily injury and liability. You can see on the Geico recommended coverage that that's $100,000, and that's per individual, and $300,000 per accident. So how much liability insurance do you actually want to carry, or do you think is necessary? Well, the idea here is that would pay for, if you were at fault, someone's medical bills. It would pay for legal fees if you were to sue, and that should be ringing bells right now about, we start thinking about litigation and legal fees. Well, you generally want to cover the amount that up to your assets. So you look at whatever your net worth, your total level of assets are, and that's the amount of liability insurance you want to make sure you have in case, forbid, you have to have have legal fees associated with any sort of accident. You can see a California minimum really only makes you get $15,000 and $30,000 per individual and per incident. So most people, I would suggest, probably have assets in greater than that, and that's why you want to make sure you're looking at your liability coverage beyond just the minimum. There's also this idea of an umbrella policy. So a lot of times auto insurance and home insurance liability maximums may be lower than your assets. So as you accumulate a significant number of assets, as you accumulate net worth, you may need more liability insurance. In that case, you can go out and get an umbrella policy to cover you above and beyond. The other component here is property damage liability. This is if you are at fault and you damage someone else's vehicle, maybe a fence on their yard. Again, the difference here is $50,000 for property damage liability on the Geico recommended. Minimum California is $5,000. So think about the cars you see on the road when you drive today. I would argue many of those are probably worth more than $5,000. And that's what you want to think about when you think about your property damage liability is how much do I think cars are worth? You probably want to make sure you have enough to repair those or to be able to pay for those if you were to be at fault. The last component here is comprehensive and collision. You can see California does not make you have comprehensive and collision coverage. And again, it makes sense. California is concerned with protecting you from hurting someone else, not protecting you from getting your brand new model 2020 Tesla Model 3 fixed or repaired. So what is comprehensive? Well, comprehensive would be things like hail damage. So think about not driving, but you get damage to your vehicle. That's when that would kick in. Collision is, as the name implies, if you were to be in an accident, this is what would ultimately repair and cover that. Again, a big thing to look at here is we don't just want to look at the premiums and let that be our determining factor for the insurance that we want to get. The other thing you'll probably notice, if you finance your vehicle, they're very much likely going to make you comprehensive and collision care because they want to be, they don't want to be on the hook for paying for your insurance.
Hey, Andy.
Yeah.
Before you move on, it looks like we have another question. So it sounds like this person is trying to lower their car insurance premium. So can you talk a little bit about maybe some strategies to be able to lower their car insurance premium?
Yeah, that's a great question, Ari. I'm glad somebody asked that. So there are a couple of things you can do when you want to lower your premium. So the first thing is you can just be a good driver. And I don't mean that sort of tongue-in-cheek or facetiously, but there are good driver discounts that are available. So if you don't have a lot of claims, if you don't get in speeding accidents, the insurance company will look at that and say, well, you're a safe driver. We'll make sure your premium is lower. The other thing you can do is you can take advantage of affiliation discounts for older individuals who are AARP members. They can take advantage of that. Maybe someone's a AAA member. There are discounts associated with that. You can also bundle car insurance. Bundling insurance. So if you have home insurance, if you have car insurance, bundle those together with one provider. And what that'll do is generally the insurance provider will provide you a discount for doing that. One of the things you can do, you can pay your premiums annually or semi-annually. As you can imagine, insurance companies generally like to get more cash up front. They will reward you for that with a lower premium. And the last thing you can do, which is probably the most constructive, would be you can actually increase your deductibles. You can see here, this is a $500 deductible on this coverage example on the left. Well, as you can imagine, if you increase your deductible to $1,000, well, that's less money that the insurance company has to pay out of pocket. And so they're going to lower your premium in order to cover that. So those are some of the things you can do if you want to lower your premium without sacrificing your acceptable amount of coverage. Okay, let's talk about home insurance, or renter's insurance. So if we own a home or we rent, there's some things we want to make sure we cover. So the first thing we'll look at is dwelling coverage. So this is actually the house you have. It's important to distinguish the levels of coverage, and there are different coverage types available, and they come in 3 buckets: basic, broad, and open barrel. So if you have basic coverage, this only says this list that we have, this is all we're going to cover. It may include things like fire, lightning, volcanic eruption, but anything outside of that, you will be financially liable for covering. And there's also the broad coverage, which is that list of basic plus a few more things like falling objects from weight of ice, snow, or electrical discharge. Freezing pipes. And then the most expansive is what's called open peril. So everything that's not written down in this list is covered. The other thing I want to point out is flood and earthquake, typically not included in homeowners insurance or maybe even renter's insurance. So it pays to check the fine print. It pays to check that fine print to make sure you're actually getting coverage. You can imagine if you live in California, earthquakes are sort of always a threat. If you live in if you live on the coastal area, again, a lot of California on the coast, that's always a threat. So make sure you're getting that acceptable level of coverage, or make sure if you need to, you go out and get that supplemental flood and earthquake coverage. In terms of all the coverage types or what's covered, I'm always reminded by that insurance company that says we know a thing or two because we've seen a thing or two, and they go through all these examples in their commercial of crazy things that have happened. Well, I like to think about the same thing about my own personal insurance, is you just never know what's going to happen. So I want to have the most broad and expansive coverage possible, and making sure you have that open peril coverage will allow you to do that. The other thing we look at is other structures. This is if you have a shed, detached garage, a fence, similar in concept to dwelling coverage, just not your primary residence. Personal property coverage. So again, this is for renter's insurance as well. And if you want to if you're a renter, then your renter's insurance would basically be homeowner's insurance with just personal property coverage. So it's a good exercise. Just go around your house or your apartment or wherever you're living and say, well, look at your kitchen. What would it cost, or what do you think everyone would cost to replace all this brand new? Go to your living room, my new TV, my couch, my bedroom set, all of those things, and kind of get an idea of what all those would cost, and make sure you have coverage that is acceptable for that. And the last thing is liability coverage. So again, just like auto insurance, we also want to make sure we have liability coverage. The concept is very much the same and similar as what we just talked about in relation to auto insurance, is we want to make sure we have enough liability coverage to cover our assets in case we end up having some sort of legal remedy that we need to pay for. Okay, so kind of the last example we'll talk about will be life and disability insurance. So as we sort of mentioned already, life insurance is what happens if I pass away. I would need to be able to take care of my family. So let's look at an example here. So this is a male, 30 years old. The policy amount is $250,000. So if this individual were to pass away, their beneficiaries or his beneficiaries would receive $250,000 in payment. I want to break this up between term and whole life. So as you can, as it kind of the name implies, you have a 20-year term and a 30-year term. So it'll only pay you out for that term. So if you're a 20-year term, by the time this 30-year-old individual turns 50, the coverage stops. 30-year term, so by the time they turn 60, coverage stops. If you look at that, well, the premiums are actually pretty manageable. And these are annual premiums. These are just example premiums, $148, $220 per year. And that kind of makes sense from an insurance perspective. Many 30-year-olds generally live to be age 50 and age 60, and the insurance company knows that they're not going to have to pay beyond that as long as you don't renew that coverage. So that's why it becomes pretty manageable. If we look on the right side here, so whole life, as the name implies, covers you for your whole life. So the insurance company knows that if you're even an age 30 male, healthy, if you get whole life insurance, they know they will have to pay you the $250,000 in order to cover that. And so because of that, we see the premium becomes much more expensive compared to the term policy. There are pluses and minuses associated with term versus whole life. Whole life has some benefits. You can think it accumulates cash value that can be tapped for various needs. Again, as the name implies, you always have it for the rest of your life, assuming you're current on your premiums. The benefits of term insurance, again, is it's less expensive. And this gets into the idea of self-insurance a little bit as well. So if you think about if you're a 30-year-old individual, you just have a brand new family, you have all these things you want to take care of your family. If you get a 20-year term, you say, well, by the time I'm age 50, I expect to have enough assets where I can self-insure myself. And I don't need insurance at that point. Sort of a risk there, right? Because by the time you turn age 50, maybe you haven't accumulated a large enough asset base and you need to go out and seek more insurance to take care of your family or to cover your family. Well, insurance for a 50-year-old is a lot more expensive than for insurance for a 30-year-old. Those are things to keep out, and that's kind of the balance when we start thinking about term versus whole life insurance. The other question is, well, how much insurance do I need, or how much life insurance do I even need? Plenty of methods out there. This one I just put on the screen is called the DIME method. It stands for debt, income, mortgage, and education. Debt and mortgage kind of makes sense, right? We don't want to saddle our beneficiaries or our family with auto debt, a huge mortgage, credit card debt. Funeral costs are sort of expensive, so we want to make sure we have enough coverage to cover that. One of the more subjective elements of this number is the income replacement. So the example here says take your annual salary times the number of years to cover your family. Well, if you're 30 years old, that's a lot of income to replace, and the amount of insurance could actually be quite prohibitive. So think about it maybe in terms of what's realistic and what's affordable versus what would be needed to help cover your family in case the worst happened and you were to have a disability. I'm sorry, if you were to pass away. So maybe it's 5 years. Maybe it's 5 years to allow your kids to get into college and your significant other to seek employment. And the last piece there is education. So as you imagine, education is expensive, college is expensive, and so having enough money to set that aside could be very helpful and beneficial. The other component here is disability insurance. So the same concept here, right? The income that we were depending on to take care of our beneficiaries and our family is no longer available. Instead of us passing away, it's because we've had something happen to us where we can no longer go to work, to be put bluntly. So the idea of disability insurance is, there are a couple of concepts here. So you have what's called a waiting period. So you can imagine the longer the waiting period, the lower the premium, because that's more time for you to heal or get better before the insurance company has to pay out. The thing to think about when you start looking at waiting periods is you want to make sure you have enough emergency savings to cover your waiting period. So it does you no good to have a 6-month waiting period but only have 3 months of savings in the account, because you have to somehow cover that gap when you're at a point in your life where you can't because you're disabled. The other idea is, well, how long am I going to have this disability insurance pay out? The idea here is you want to make sure you have enough disability coverage to cover you for your working years. You can get that up to age 65. Again, as you would imagine, the longer your coverage lasts, the more expensive that premium is ultimately going to be. And the other idea is, well, just how much do I need to get in disability insurance? A rule of thumb is you want to target about 60 to 70% of your gross pay in order to replace that income that's ultimately lost. Okay, Ari, it's coming back to you here for some insurance example questions. So
all right,
first,
the pressure's off.
Yeah, let's hope you were paying attention. So your first question here is, you've just had your first child, you and your spouse continue to work. Would you purchase life insurance?
Thanks, Andy. That's a really good question. And I kind of tied this back to that DIME method that you were talking about a little bit earlier. And in this particular case, it would be worthwhile to look into life insurance, because essentially, if one of the spouses passes away, you don't want to put the other spouse at a disadvantage and be left with a ton of debt to deal with after your death. And so things like paying off a mortgage, that's a really good consideration, especially when thinking about, purchasing that life insurance. Even in the case that, let's say that a spouse didn't work, it might still be worth looking into life insurance as well, especially because that spouse is still providing things like, let's say, for instance, childcare that the surviving spouse would have to replace in that case. So in both cases, it would be worthwhile to look into it.
Yeah, I think that's exactly right, Arya. I think it's, again, it just gets down to your own personal situation and what would be best for you and your family. All right, you have one more question. So this one, you just camped outside the Apple store all night to get the brand new iPhone that just came out. And at checkout, they say, hey, would you like Apple Care coverage? It only cost you $300. What would you say?
Yeah, so this question is a little bit trickier. Obviously the major benefit of getting something like Apple Care coverage is just that peace of mind. But one thing to really keep in mind is just the fact that companies tend to push this type of coverage because it is profitable to them. So, it's really good to always consider two major things. I think, one is just the likelihood that the product is going to fail. And two, how much it would actually cost you to repair and replace if it actually did fail. Because a lot of the times, you add up all the numbers and the coverage actually ends up costing more than the replacement cost. So just make sure that you keep that in mind as well.
Yeah, absolutely. All right, so it gets into the idea of that self-insurance concept. Maybe this wouldn't be financially devastating for us if we have to have our iPhone or any appliance end up breaking. All right, thanks, Arya. Well, you passed, so I appreciate that. Well, that concludes our presentation. So I've left a little bit of time for questions. So at this point, are there any questions that we've had come up throughout the presentation?
Let me just check the queue really quick. Yep, so it looks like we did. So the last one is, this is actually a really good one. So let's say that you get life insurance through your work. Is it worth it to explore getting other policies outside of that?
Great question. The answer is, of course, and all things insurance is it depends. So let's think about a couple of things here when we get life insurance through our work. So the first thing I think about is, well, is this coverage amount enough via that DIME method, right, that we looked at? Would this amount even be enough if I were to pass away? So the first thing you look at, is it enough? If it's not, you probably want to go seek insurance outside of your employer. Again, the benefit of insurance with the employer is it's generally much less expensive. So that's a trade-off there. And then, the last piece I would think about is a lot of times people don't stay with their employer for a long time. We see that the amount of time people stay is decreasing. So you think about it, maybe you're maybe a little, as you increase in age, we talked about that 50-year-old term policy for a 50-year-old versus a 30-year-old is much more expensive. So if you were to say, leave your job and then go get another job, and maybe the coverage isn't as appealing or isn't as adequate, and then you'd be forced to go out in the open marketplace at a time where it's maybe less advantageous for you, that would be something to consider, where maybe having your own life insurance policy where you get a little bit younger and as long as I just pay the premiums, I'll be covered. So those would be things I would think about when I start considering my work life insurance versus a personal life insurance. Arya, anything you would add on that?
I think you hit everything. Great job.
Great. Any other questions we can help out with?
That's it for the questions.
All right. Well, thank you so much, everybody who joined us today. We hope this was informative. We hope this was helpful. And again, this is recorded. It'll be available Friday, YouTube or dywealth.com. And we hope you join us next week for our presentation on taxes. Thank you very much.